Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week, it's my turn to have another conversation with Andrew McHattie, the editor of the Investment Trusts newsletter and a long-standing co-host on this particular podcast. Welcome, Andrew. I think we'd like to start by saying that this has been a relatively quiet week, but that's been quite good for the investment trust sector, actually. We've seen the index of investment trusts make a modest little gain, which is nice this week. And the markets have been relatively benign compared to some weeks we've had recently. So anyway, let's dive straight in and start talking about some of the news out of the sector, since that's what interests our listeners mainly. And let's start with Chrysalis, shall we, the early stage private company investor, where, if you believe the newspaper reports at least, there's some potentially interesting news coming along.
Well, it's great to start with some good news, isn't it? And I do think with Chrysalis, we've had good news, actually. Long-awaited good news, in fact, because one of its investee companies, one of its key investee companies is Klarna, the consumer borrowing company. And they have just finally been through their IPO in New York. They had planned this earlier in the year and it was derailed by the tariff tantrum, but they did manage to come back to the market and they've got their IPO away now. So it's now floated and this is good news for Chrysalis. So Klarna's about 15% of their portfolio and Klarna floated at $40 a share, which actually compares to Chrysalis's carrying value of $45 a share. So it doesn't sound that great. But the good news is that it's got away. The shares are trading roughly at that kind of $40 to $43 level. And now, of course, instead of having a 15% stake in an unquoted stock, Chrysalis has a 15% stake in a fully liquid listed company where the value is known. So that should help, I think. And as well, this is a signal to the market that actually everything is getting back to normal with flotation. So that's great news for Chrysalis. So that's been actually a very useful tailwind for the shares. And they've sprung up and actually increased to about 128.5 pence, which is a nice rise actually over the month. And there's more. On top of that, their really big holding in Starling Bank, which is 42% of assets, is also potentially going to go through a transaction which would imply an uplift. So there's plenty of good news here.
Absolutely. The Starling news is only reported, I think, so far, hasn't it, in the newspaper. But it's very good news because, as you say, if it signals that we're coming to an end of this gumming up of the private equity market, as I call it, where they can't actually realize value by listing holdings, it could have implications across the sector as well, if this is an indication at all of how the trends are developing. And to the extent that the big discount widening in the listed private equity space has been due to this illiquidity around a large part of their holding, that has to be very positive. I think I know from looking at certainly some of the brokers' comments on the situation of Chrysalis that I saw one broker came out this morning talking about if Starling actually does develop as we've been told it might, they're looking at a share price of around 180p for the NAV at some point before the end of the year. Well, I think actually the end of this month. I mean, that would be significant and that would give certainly the shares a target to go for. Would you think that these shares are ever going to go back to a premium anytime soon? I would suspect not. But nothing like a bit of momentum to get things going, is there?
Well, momentum is very important. And I saw that broker's note, and actually the target price there was 155, which did imply a significant narrowing of the discount. And it's already come in quite a lot because it was around 40% at its trough. And it's come into about 25 or maybe 30, depending on exactly where that NAV ends up. But I do think now that the shares do have this new following and a bit of new confidence, and that's really important in this sector. We've seen this a lot in the growth capital sector with other trusts as well, like Seraphim Space, where you get these massive volatile swings in the share price that are not really nothing at all to do with the NAV. So I do think there's good scope for further gains, actually, with Chrysalis.
I'm just looking down the list of the sector private equity and this early stage private trusts. I'm looking at the discounts. I'm looking down the list. They're all kind of coming in below their medium-term averages over the last year or 2 years, that sort of thing. So Chrysalis is now on a discount, I think, of around 26, something like that, according to my data anyway. Schiehallion is on 22. These are notable gains, as you say, in the discount. I mean, that is momentum before our eyes, I would say. Can you remind us what the board of Chrysalis have said they're going to do if these realizations actually continue? Are they going to return money to shareholders? What are they going to do? Just suppose that Starling actually does get to the market. What do you think they're going to do with the cash?
Well, they do have a capital return plan, and a lot of the capital at the moment is being cycled into share buybacks, and that's actually been extremely helpful and supportive for the price. So I do think actually that money is going to find its way back to shareholders one way or another. Now, because Starling is such a large lump, I think if that was realised in some way, then you could see a different sort of capital return. But that's interesting actually in the case of Klarna, because Chrysalis has not actually sold a single share. They decided to hang on to their entire holding because they have a very positive view of the future. So if Starling Bank were to have some kind of IPO flotation or even a trade sale, which is less likely actually, then Chrysalis wouldn't necessarily have that money. It would just have a liquid security where it could sell some down and then perhaps carry on with its share buyback program if that discount is still wide.
I guess the flip side of that, of course, is that we do know that in some cases when companies achieve their IPO, that their subsequent performance is actually disappointing rather than good. But we have to assume, I think for the moment at least, that this is not how these things will develop. Klarna is an interesting business that I wouldn't be sure that it's going to become the superstar of the stock market, but we'll have to wait and see anyway. It's good news so far, as you say, for the shareholders. And Chrysalis shares, I notice, are up around a third so far this year. So certainly, apart from Seraphim Space, the best performer so far this year across the private equity spectrum. So that's good news. Okay, let's move on and talk about another couple of developments. This is in the European sector, where listeners may remember there have been a couple of merger proposals. The sector is going to be shrinking, assuming these go through. What is the latest status updates on those mergers, Andrew?
Yeah, let's get back to the consolidation news that we've been talking about for most of the year. So there are two mergers here where there have been some updates. The first one is Henderson European, which is merging into Fidelity European, and that's at an advanced stage now. We've just passed the date where Henderson European shareholders had to decide whether they wanted any cash out or whether they were happy with Fidelity European shares. And that actually had an interesting outcome, I think. Now, the cash exit option was at a 1.75% discount to the formula asset value, so pretty close actually to the asset value. And there was a maximum limit on the cash exit of 33.3%, but that limit wasn't hit. So in fact, the cash option was only taken up by 29% of the shares. So those who wanted out will get a full allocation and a full exit. So I think that's very good news because there's no overhang, and I think that's good news for Fidelity European going forward. Then the other one is European Assets Trust merging into the European Smaller Companies Trust. That's the Janus Henderson Trust managed by Ollie Beckett. And that one has published its timetable. So that's happening in October. And again, there's a partial cash exit on the table there. Now, this one is limited to a maximum of 15% of the assets at a 2% discount to the asset value. And here I think maybe the decision is a bit different because this is a smaller companies trust, the European Smaller Companies Trust, as the name says. It's actually on a wider discount. So it's on an 8.2% discount at the moment. And I think that means the 2% discount that you're being offered for the cash exit is relatively attractive. So I think the cash exit may be a more popular choice in this case.
What do you think this tells us about the overall market for investment trusts? In other words, this continued consolidation phase. The European sector has looked ripe for a bit of consolidation, I think, for a while. In particular, with situations where you've got managers with two trusts in the game, so to speak, I think has been a target. Is that us done now in the European sector, would you say?
Well, I think maybe it is, yes, because Actually, Europe, I think, looks quite promising. The prospects are good. So on that basis, I don't think there's any particular desire for investors to take more money out of the sector. And I think actually in the case of European Assets Trust, that was a fairly obvious laggard, actually. And I think that one probably did have a good reason to disappear. But I look at the remaining ones and I don't think there's any obvious sort of low-hanging fruit there that needs to be picked. So it could be that we're coming towards the end of this consolidation cycle now, particularly if we do perhaps one day see the return of IPOs and corporate finance departments have other things to do. So that's a bit cynical maybe. But anyway, my answer really is that I do think we're coming towards the end of it now.
Shame on you for even suggesting that possibility. I mean, how could you possibly say that, Andrew? I'm shocked. Anyway, just looking across the sector, we've got 6 trusts at the moment in there with market caps ranging from, well, Baillie Gifford is the smallest one, I think. This is in the mainstream European sector. Baillie Gifford European, that's around market cap 330 million. And Fidelity European at the top with 1.6 billion, which is very much the kind of the heavyweight performer in the sector. But leaving aside Henderson European, we've got BlackRock Trust, we've got JP Morgan, and we've got European Opportunities Trust. I mean, I guess European Opportunities Trust, that one is still struggling to get back into the kind of form that will allow it to continue when its next threshold comes up. That was Saba's original target, essentially, and still struggling. I think it has a performance trigger that it may or may not meet when it next comes round. But is this looking a more healthy sector overall? I would certainly agree with you about that. Let's talk next about something else that's moving. And if you're a shareholder, probably good news. That is to say the gold price has been extraordinarily strong this year, indeed for the last 3 years. I'm very happy to say that since I have quite a large chunk of that myself. Not difficult to find the reasons why. But it has been noticeable that in general terms, sort of gold mining shares have lagged the gold price performance, but not if you're a shareholder in Golden Prospect Precious Metals, ticker GPM, which has been performing quite nicely. So tell us more about that one.
Well, I think this is really interesting because you're right, I think, in your introduction, Jonathan, that we've been through a slightly quieter period actually for the investment trust sector and for equity markets. But the real excitement over the summer was in the gold price, which has soared to new highs. It's over $3,650 an ounce now. If you look at a chart of that, you'll see it's really soared, actually. And it's been a perfect storm. There have been so many factors backing gold. I won't go through them all now, but it really has been an excellent environment for gold to rise. And I think there's really only one way to play that directly in the investment trust sector, and that is through Golden Prospect Precious Metals, which is 86% exposed to gold, and there's a bit exposed to silver and other metals as well. And it does this by buying small mining stocks. And you won't have heard of these, I think, on the whole, unless you're a specialist. So things like Equinox Gold and Southern Cross Gold. And I think there's a couple of points to make about this, actually. One is that it's terrific to have this ability to buy into these things because it's highly unlikely you're going to identify these companies yourself and make these investments. So it's good that this trust exists. And that's relevant because it's a very small trust. And with all of this consolidation that's been going on, there's been a lot of pressure on smaller trusts to wind up. But I'm very pleased this one exists with its £72 million of market cap, which is under the radar for many, but it's perfectly okay for private investors. And actually, the trust has done extremely well. But I did just read the results announcement, which came out this morning. And it was interesting there that the managers said their real enthusiasm now is for the miners themselves. It's not really about the gold price because they say actually so far in this gold rally, the miners have moved up more or less 1-to-1 with the gold price, whereas historically, because they're operationally geared, the leverage ratio is more like 2-to-1. So what they're saying is that there could still be a period of catching up for their equities to come. So again, maybe more scope here for a further rise.
Yes, I think that's very fair. It's certainly true. If you look at the ratio between gold and the miners as represented by the gold mining index, they've certainly lagged until recently, the last few weeks anyway. Part of that, I think, is just that, shall we say, that there's been serial disappointment amongst those who invest in gold mining shares. You have to be pretty brave to want to do that, and they're always dreaming of massive gains. But unfortunately, they don't always materialize. In many cases, I think it's fair to say the managers of the gold companies tend to do rather better than the shareholders. But let's hope that that's not the case. They do certainly have periods of significant gains. So that's good news. If you're a gold bug or anybody who's interested in gold miners, there's a very interesting development. There are some other trusts which have some exposure to gold. BlackRock World Mining, I guess, would be one, but it's a relatively small part of their holding, and it doesn't really drive the share price in the same way as it does. So the share price of that one has done pretty well. BlackRock World Mining has done quite nicely this year, having had quite a tough period. Let's move on then, and let's talk about another trust that's been in the news for about a year now, and that would be PRS Reit. This is a property trust that has been building out a whole suite of property for rent. It's a sort of private for rent business model. What's the news there? We've been waiting for a news of an offer for that one for some time, have we not?
I'm really intrigued by this one, Jonathan. I think this is a really interesting story. And yes, it's been going on for quite some time, actually. So if you can remember, Harwood Capital forced some board changes last year. And it was back in October 24 when the trust actually began a strategic review. And it's been a long wait, actually, for shareholders who may well have expected a conclusion before now. But we have some fresh news on this, which has given the price a small fillip, but it's notable that the price now is about 105 pence a share. So keep that in mind when I tell you what's happened. So there was already one potential bid on the table here, which came from a company called Long Harbour, a UK company, and that was a possible bid of 115 pence per share, which they indicated in June, but said that was subject to financing and due diligence. Now, that didn't look especially generous. I think at the time that was about a 17.6% discount to the NAV. And we waited for further news, and then we didn't really hear anything at all until last week when there was an update saying that actually, as part of this formal sales process, the US private equity giant KKR has now joined in. So there's an extra potential buyer in the process now. And we don't have any further information, but I do think there's potential here for a bidding war to ensue. And who knows where it could end up. But I think potentially we could end up close to 130 pence if these two bidders both get their financing arranged, if they both want these assets, if they're prepared to bid it up against each other. There's a lot of ifs there. And clearly the market is very skeptical about this occurring, hence the share price of 105. I think if you're a speculative investor, this is one you could have a look at.
Yes, I think it's been a very interesting development. Obviously, as you say, Harwood Capital and others involved in this process trying to effectively get a sale of this particular trust after the board originally put forward a series of proposals that the market didn't like, which would have seen them continuing in operation. It has been interesting. I have to admit that I did own some shares in this one. I'd managed to get in quite a decent price, but I got a bit bored waiting for something to happen, and so I sold them some weeks ago now at above the current price. So it is interesting. I think it's pretty clear that Harwood and others have been trying to engineer a bidding war that would be in the interests of shareholders. And it'll be interesting to see whether this happens. But as you say, the market does look skeptical. The price has perked up a little bit, as you say, on this news. But meanwhile, we're just going to have to wait, I guess. And I'm not sure whether I'm tempted to go back in there or not, because, we've had the best of the gains that have been seen. But I guess if you got anywhere near 130p, that would be certainly worth the effort over a very short-term horizon at least. So that's been one where the activists, as you like, activism has forced a rethink about the future of the company, but it's yet to produce the final result. So we'll keep watching that one with interest. Let's talk about another situation, not quite so happy. And this is Third Point Investors, which is Dan Loeb's listed hedge fund, where efforts of dissident shareholders to change the board's mind about something have rather signally failed, I think it's fair to say.
Well, they have. So I'll just come back to this briefly because we have discussed this one before and the governance issues around this vote. And the vote has gone through now and it fell in favour of Daniel Loeb and exactly what he wanted to do, which was to changed the trust from being a hedge fund into an operational life insurance company, which many shareholders didn't want to do. And the terms of the tender offer to take some cash out were not very good, not very generous. But there we are. It has gone through, and the tender offer was well taken up. So it will only be satisfied to the extent of 45.8% for investors. So they're only getting a little less than half of the money out there that they'd like to take out. And they're not even getting it all up front. So you get roughly $28.50 up front, with another $2.50 to come at some point. And what's happened now is that Third Point Investors has been delisted, and then it's been relisted as Malibu Life Holdings Limited. So this is another trust that has disappeared. It's not a great outcome. The share price is much lower now, and it's not a good governance precedent either. So a pretty sad tale all around, I think.
I could not agree more. I think it's just been indicative of the problems that can arise, particularly when you have historically has been US hedge funds in particular, have been tricky customers to deal with, I think, or particularly where the managers in this case have a significant holding. Now that's normally meant to be a good thing, alignment of interest, but we've just seen the downside of that. And of course, there was a recent rules change which made it easier for them to push this through than it would have been the case in the past, to push it through without giving the shareholders who wanted an exit a full opportunity to do so. I guess one should say that the logic behind this deal, I think, is very much, and I'm sure this is what Dan Lowe would have been saying to people, well, this is a great opportunity. We're going to turn this into an insurance company, and we're going to basically do a bit of a Warren Buffett here. We're going to take the premiums and we're going to invest them and use it as a source of capital. Well, that may or may not be the case. We don't know. But anyway, I think, as you said, good riddance to this one on the whole. Not been a good role model for the sector. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Let's talk about Saba Capital. We haven't talked about Saba Capital for a while, except briefly in passing. They're still very much around. I gave a talk this week at the Mellow Investment Trust event, and on my slide deck I had a list of all the Saba shareholdings, where they are at now, and it's been a pretty interesting thing to look at. But the news here that is of more perhaps significance is that they've decided to get involved in the alternative space for the first time, which is interesting. They've been nibbling away, I think it's fair to say, rather than launching a broadside in a couple of trusts. So perhaps you could tell us about that. Who are they targeting and what do you make of it all?
First of all, Jonathan, I'm pretty impressed if you got all of Saba's holdings onto one slide, actually, because they do have their fingers in many pies. But I think there's been a bit of a shift of strategy because, of course, up until now, they've really been targeting the equity investment companies with liquid assets where they can hedge that exposure. So what they're doing is they're really just taking a position on the discount, and they don't really mind whether the underlying holdings go up or down in the meantime. So that's a very sensible strategy for them. But now they seem to be realizing perhaps that the opportunities are starting to slim down amongst the equity investment companies, and they're moving into the alternative assets for the first time. And this is really very different because they can't hedge these assets, and also they can't expect a very quick resolution because, as we've seen from wind downs that have occurred in these alternative asset sectors, it can take a very long time and be a difficult process. Anyway, they have dipped their toe in. So a couple of stakes I've noticed. One is that they've taken a 5% stake in SDCL Efficiency Income. That's got the ticker code SEIT. And that's a renewable energy trust that does hold individual chunky assets. So potentially those could be sold off. And this has been on a very wide discount. Actually, I think an unusually wide discount against the peer group. It's one I've noted in my newsletter, actually. And before Saba got involved, it was on a 38% discount, which is extremely wide. And that's not because it's done badly. It really hasn't done very much wrong. It has recently sold down a small asset to demonstrate that the value was correct. And actually, I think it's a perfectly decent trust. Now, the share price did react a bit when Saba announced this 5% stake, but it's settled back again. So actually, they're still on a 37% discount now. So I think there's some definite value here, and it'd be really interesting actually to see what Saba says in due course. We don't really know exactly what its strategic viewpoint is here. So we'll see on that one. And then very quickly, the other one is taking a 2% stake in Life Science Reit, ticker code Labs, which is a property company specializing in life science in Oxford, Cambridge and London. And that one is already on the chopping block, really, because it's in the midst of a strategic review, which is, I think, pretty likely to try and engineer a sale. So it's going through that, but it's still on a massive discount of 45.8%. So the share price is about 41 pence, NAV 76.5. Again, that's quite a big cushion. So maybe Saba is just being attracted here by the size of the opportunity. It may be much more difficult for it to extract value, but the pickings could be very rich.
Yes, I think that's fair. And as you say, well, the Labs one looks like just a little bit of kind of sort of old-fashioned arbitrage, really. That seems pretty straightforward to me. But it is interesting to see whether they will put their toe into other situations. I can tell you that just looking through these holdings, I got the sort of ones up to the end of August. It's interesting also, they've been reducing some of their existing holdings and increasing one or two others. So you might be interested in some of the names there that they've been increasing their holdings in. This is before this news came out about SDCL and so on. So the margin, they've increased their holdings in Edinburgh Worldwide and BlackRock Throgmorton, and also Impact's environmental markets. This is at least data up to the end of August. You never know whether they may have moved since then, of course. And they've also been involved in Bellevue Healthcare, which, as you know, is also one that's potentially on the chopping block at the moment. And in terms of what they've been reducing, well, they have been reducing their holding in Worldwide Healthcare Trust and Montanaro European Smaller, things like that, which the last case, Montanaro European, sort of came to a deal with them, if you recall, and Saba's been selling down in that way. So they're having a bit more capital to play with, and I think they're still very much around. And it'll be interesting to see where they go from here, whether they, as you say, branch out into alternatives. I think they've got a bit more cash than they had before. So that's Saba for the moment. Let's talk about another trust that may be in trouble, and that is Baillie Gifford Shin Nippon, which is a Japanese smaller companies investment trust, which invests obviously in the normal Baillie Gifford way. What do you make of this one, and why do you think that there may be some action coming here?
Yes, this is an interesting one. If it was a Shakespeare play, it would be a tragedy, I'm afraid. It's a hero to zero story arc here. I remember this trust being such a great performer over many years, actually. Whenever I looked at the Japanese smaller company sector, certainly I think in the 2010s and before, Baillie Gifford Shin Nippon was very much at the top, and it stayed there. For many years, its growth strategy was exactly the right one in this market. However, that growth style has really gone out of favour, and this trust has underwhelmed now for quite a few years. If you look at the 5-year track record, it's just appalling. It's really awful. Actually, out of all investment companies across the entire universe, Baillie Gifford Shin Nippon is ranked 228th out of 237. So really near the bottom over that period. It's lost about 28% or 30% of its NAV over that time. So its recent history is really poor. And actually at the interim stage, at the half-year stage, again, it underperformed its index with a 3.4% return against 7.9% for the index. So the board, I think, has been under pressure here, and it has now said that if this underperformance continues, it will explore all available options, which I think is code for that'll be the end of the road for you, and it may perhaps merge. But there are some changes here. So they did change the manager in May. I think they've been refocusing the portfolio a little bit. And there is already a partial tender offer in the books here. So if they underperform in the 3 years to the end of January 27, and they're currently well behind the benchmark here, then there's a limited 15% tender offer at a 2% discount. But I think perhaps before that, if the underperformance continues, there could be a larger action at play here, because I think the board is just coming under pressure. And we've already seen so much merger activity in this sector, haven't we? I think about 18 months ago, there were 11 Japanese investment trusts across the range. Now there are 7. Who knows? We might get down to 6.
Yeah, it is an interesting story, as you say. It is, I think, fair to say two things. First, that obviously the share price has noticed that something's going on, or at least the market has noticed something's going on, and the shares have done quite well this year. But if you're an existing holder, you won't take much comfort in that, since they have come down such a long way. And I think it's fair to say also that this performance comes against a period when the Japanese market overall has been doing rather well. The Japanese, those that survive anyway, have been putting in some good performance numbers. So do you think this is a case of one or two other Baillie Gifford trusts have come under fire from Saba amongst others, and the result in a couple of cases has been that the board has told the manager effectively to trim the tail, if you like, to make it much more concentrated portfolios? Do you have any insights into why particularly this has gone wrong, the strategy?
I don't especially. I do feel actually that it's been going wrong for quite some time. I think maybe that's the problem, that Baillie Gifford, of course, is very much attached to its strategy and is not going to change that. So I think maybe it's just the board issuing something of a deadline and saying, look, you've got to shape up or ship out here. And actually, we're not going to tolerate this underperformance forever. And I think maybe making a public declaration of that is just significant in supporting the share price now and making sure that Baillie Gifford understand that. I dare say that's been said in private actually for some time, but well, I think we'll just have to see if it plays out. There is a terrible risk here that we've seen before in this sector, that actually you come out of the growth strategy at exactly the wrong moment when it starts to work again. And it raises an interesting question of how patient you can be when a strategy that has worked actually brilliantly for an extended period in the past, it goes out of fashion, goes wrong, and you have this terrible period. I don't know how long you're patient for. I think historically in the investment trust sector, boards would have cut it a lot more slack actually and given it more leeway. But of course, in this modern environment where you're at risk of arbitrageurs taking positions and other fund management houses desperate to take on your assets, you don't have that much tolerance any longer. And I don't know, that could count against us in the long run if we're taking out trusts at the wrong moment in the cycle.
Yes, I guess it also hasn't helped that the other two trusts, which are in the Japanese smaller companies sector, both of which pursue a very different strategy. This is AVI Japan Opportunity Trust and Nippon Active Value, both of which focus on targeting companies where there's scope for corporate governance improvements. They've both done very well. And so the contrast has become more painful, if you like, whereas Baillie Gifford Shin Nippon is still doing, if you like, a slightly different strategy where they're looking for growth opportunities, as you've said. Well, they could well be right on the last point as well. Who knows? It could become a source of regret if the board gets too active at just the wrong moment, has happened. Let's finally then turn to Dunedin Income and Growth, which is an interesting trust, perhaps not widely followed, but tell us what's caught your eye about that one.
Well, this is an AIC next generation dividend hero, this one. So very much at the more conservative end of the market. It has raised its dividend for 14 years consecutively, which is why it's on that list. But now the board has decided that actually its current dividend policy is not sufficiently attractive, and so it's making a change. So let's dig into this. The dividend yield based on last year's dividend payment of 14.2 pence per share is about 4.8%. So that's not bad, actually. It's clearly higher than the UK equity market, and it's actually higher than the average for the UK equity income sector, which is 4.1%. So this trust already had a yield advantage here. But it's not really the most attractive of trust in the sector, in my opinion, and it hasn't been the one you'd probably pick. So actually, the board now is trying to provide a little bit of extra differentiation, and it's switching to an enhanced dividend. So it's going to use capital as well to pump up that dividend and take the yield much higher. So it's going to pay a minimum of 6% of the NAV. And because there's a discount here as well, that means the yield is actually going to rise to about 6.5% because it's planning to pay 19.1 pence per share in this current financial year. And I think this is really interesting. I'm not a big fan of these fake yields, to use a Trumpian expression. I think that actually one of the great merits of the investment trust sector over so many years has been its transparency and simplicity. And I like dividend yields that are backed by real income because you can pitch a dividend yield anywhere if you're paying it out of capital. But the trust does have a rationale for it. So it is justifying this on the basis that its portfolio companies now are returning capital to shareholders, not just through dividends, but also increasingly through share buybacks. So what it's saying is, well, we're reflecting that trend in the market by paying this enhanced dividend. And I'm not sure I really like this approach. They're not alone in this because Temple Bar has also done really much the same thing and is paying an enhanced dividend, again, to reflect those share buybacks that are occurring. To me, it still doesn't quite sit well with me. It's not a comfortable thing for me, but this is the way the wind is blowing. And there's a demand for this higher income to make these investment trusts attractive if you're comparing them to yields elsewhere, of course. If you have bonds and gilt yields well over 5%, then your dividend yield here under 5 is not competing well. So they're pumping up the dividend. That's what's happening.
I think we get a measure of what you feel about that one, Andrew. It's certainly fair. But it's interesting, it's put the focus on, as you said, the UK equity income sector, where there's a lot of trust, traditionally been one of the kind of core elements in the investment trust offering, if you like. And a lot of trust in there. We have seen some change of managers in that. About 5 years ago, we had 3 trusts change their manager. It looks like Murray Income is going to join that list. That's on the block at the moment. What are your thoughts about the sector overall? As you say, rising yields put a challenge to the sector, but is it also about trying to compete against your peer group a little bit to avoid being rationalized away, shall we say?
Well, it could be. It's a large peer group for sure. And actually, it hasn't undergone too much in the way of rationalisation yet, I don't think. And most of the trusts here are quite big and well established with long histories. And so there's not necessarily any reason for them to disappear. But I don't think Dunedin income growth was really standing out. So this does push it well up the rankings when it comes to the yields. I think it'll place it probably in second or third position. So it will potentially provide some specific attraction to pull investors in. But I don't know. I think investors maybe are a bit more sophisticated than that. So if they're looking at total return, this trust is not currently going to be at the top of the list still.
Yeah. I guess this trust is managed by Aberdeen, and they have a number of trusts in this sector, not just Murray Income. So we don't yet know what the result of that review is going to be. But if there is a change in manager there, obviously I'm sure Aberdeen will pull out all the stops to try and retain it, but it may go elsewhere. That could have some implications for that particular management house. So outside these specific investment trust news items, Andrew, I wonder if I can ask you about LTAFs. Long-term asset funds. These are instruments that the government has approved as ways to attract more investment into private companies and private equity firms. We learned this week that Hargreaves Lansdown, which is the biggest retail platform out there, has started offering its clients access to an LTAF. They're doing it in the first instance with 2 Schroders capital-backed long-term asset funds. Now, a number of people see these as potential threats to investment trusts. What are your thoughts on that particular subject?
These have been talked about a lot as a future competitor for investment trusts, and we'll have to see how much demand there is. I'm not going to be an early adopter here, but some people will be interested in looking at these. I think they're worth learning about because they could be interesting in the future. So these are a hybrid. They're an open-ended fund that will invest in illiquid assets, but they're going to then restrict your liquidity as an investor. So you can put money in or take it out only at set times, so not every day. They're certainly not the same as investment trusts, because one of the beauties of investment trusts is that they do provide you with constant liquidity, even when the underlying assets are illiquid. And LTAFs are not going to do that. So, as the name suggests, they really are for long-term investors who are just prepared to put patient capital away. And that's all very well, but of course we're living in a pretty feverish environment at the moment where markets can be subject to very rapid changes. We only have to look at what's happened in the US in the last couple of years as an example of that. So I'm not certain that many investors are prepared to tie up money in that way. But I suspect this industry is going to develop because many fund management houses may see it as a new opportunity, and they're always after new assets, aren't they? So we may see this develop, and it will be some kind of competitor for the investment trust sector. We'll see how much demand there is.
Yes, I think that's a very fair summary. I noticed, I just looking at the Harvey Lansdowne website, and they do say, because they have to say, of course, LTAFs are considered high-risk investments and can be highly volatile. It's difficult to access your money in the short term, and their value can go down as well as up, blah, blah, blah. They should only be a consideration for experienced investors with larger portfolios. We suggest they form a small part, no more than 10% of a diversified portfolio. So they're putting in all the caveats, of course, as they would do. But the sort of basic story, and I think why the industry hopes they'll do well, that is apart from the investment trust sector, the rest of the industry hopes they'll do well because you will be able to present them as actually as relatively low risk, because there wouldn't be a huge amount of volatility there because they won't be marking to market and you won't get that volatility. And they'll be able to say things like, well, there's so many more private companies these days than public companies, blah, blah, blah. This is giving you access to a wider pool and so on and so forth. And you will be able to get your money out, but probably not for a while, only at periodic intervals. But we have to acknowledge it is potentially a competitive threat to listed private equity trusts. And also that goes with the competitive risk from passive funds, which we've had for a while. So I guess that finally leads me to a thought, which is beginning to hear people saying that finally we're going to get a period where active management will do quite well relative to passive trust. That's all based on the premise that the mega cap big tech stocks are going to lose their kind of market dominance, and therefore there's a chance for active managers to finally, in aggregate, make some more money than you could do by getting out of a passive index tracking fund. I don't know what you think about that. It is true there are periods when that is the case, when the majority of actively managed funds do outperform passive equivalents, but we haven't seen that for a long time now. And of course, all the investment trusts are actively managed, so that's the issue. Well, I'm going to ask you this question in a different way, Andrew. I'm going to say, you're not going to put any money into LTAFs. Are you going to put any money into passive funds or reduce your holdings of passive funds if you have any, because of the potential for active management doing better from here?
I don't hold any passive funds. I don't like that idea at all. I love the idea of picking great managers, actually, and letting them do their work. And of course, whether you're able to do that or not is a different question. But in principle, it's a lovely idea. And I do think maybe we are going to enter a period, actually, where there's more scope for really clever managers in specific areas, in smaller companies which have lagged so badly for so long now. I think we might be entering a period where they can do better. And I do think capital is going to flow out of those mega caps in the US. So I'm not making any shift in my portfolio as a result, but I'm already very keen on finding good managers where I can. That's my work. So I'm going to eat my own cooking.
Quite right, too. And I'm sure that it's more than vindicated itself over time. So that brings us to the end of this particular podcast. Thank you again, Andrew, as always, for sharing your thoughts on the latest news from the investment trust sector. There's never any shortage of it, and you'll always hear what's been going on by listening to this podcast.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.